So you've seen those ETFs flashing double-digit dividend yields. Monthly income, 10%, 12%, sometimes even more. Sounds amazing, right? But here's the question nobody likes to ask. If the yield looks that good, what's the catch? Today we're talking about covered call ETFs, why they can look super attractive on the surface, and how they might secretly be turning your portfolio into what I like to call a portfolio. Let's break it down in simple language, so by the end of this video you'll know what a covered call ETF actually does, why the upside is capped, how your capital can slowly erode, and how to think about these funds in your own investing journey. Before we jump into covered calls, let's keep it basic. An ETF, or exchange-traded fund, is just a basket of investments you can buy like a single stock. It might hold 50 stocks, 500 stocks, or follow an index like the S&P 500. So instead of picking one company, you get a whole group in one click. Easy. Now, a covered call ETF is like a regular ETF that decided to get fancy and sell options on top of the stocks it already owns. Let's say the ETF owns a stock that's currently at $100. The fund manager can sell a call option with a strike price, maybe at $105. By selling this option, they collect a small payment up front, called premium. In exchange, they're making a deal. If the stock stays below $105, they keep the premium and keep the stock. If the stock goes above $105, they might have to sell the stock at $105, even if it's trading at $110, $120 or higher. So they get immediate cash, the premium, but they limit how much profit they can make if the stock goes up a lot. That's the covered call. The call option is covered by the stock they already own. You might be wondering, if they're giving up upside, why would any fund do this? Simple. Option premiums can be a steady source of income, especially when the market is jumpy. When markets are volatile, option prices usually go up, funds can collect more premium, and they can pass that income to you as a higher distribution. That income sounds great, but remember, it's created by giving away some of the future growth. They're trading tomorrow's potential gains for cash today. Now you might be thinking, wait, they get paid just for selling these options? That sounds awesome. And that's exactly the appeal. Many covered call ETFs pay high dividends, often pay monthly, show big shiny yield numbers on the fact sheet. If you're chasing income, this looks like a dream. Why would I get 2% from a normal index fund when I can get 10% from this covered call ETF? Well, this is where the portfolio part comes in. Remember that call option they sold at $105? Imagine the market suddenly has a strong year. The stock jumps to $120. A normal investor who simply holds the stock enjoys that full move from $100 to $120. But the covered call ETF? It likely had to sell around $105 or give away most of the upside because of the option it sold. So while the market rallies hard, the ETF doesn't fully participate. Its upside is capped. That means, in strong bull markets, covered call ETFs usually underperform. They give up future growth in exchange for income today. It's like trading long-term potential for short-term cash. Here's the scary part that many investors don't realize. If the fund manager wants to keep paying you a very high dividend, but the market is not growing fast enough to support it, where does that money come from? Some of it comes from option premiums, dividends from the stocks inside the ETF. But when that's not enough, the fund might sell some of its holdings or return part of your own money back to you as distribution. This is where things can get misleading. You see a big fat yield number. You see cash hitting your account every month. You feel richer. But the actual value of your shares, the ETF's price, might be slowly drifting downward. You're not just earning income. You might be slowly eating your own capital. Let's keep numbers simple. Imagine, you invest $10,000 in a covered call ETF at $100 per share. So you own 100 shares. The yield is 12% per year, paid out as monthly income. Year 1, you get $2,200 in cash. That feels great. But because the fund is capped on upside and the market was only average, the ETF price slips from $100 to $95. Your situation now, you've received $200 in income, but your 100 shares are now worth $9,500. Your total value is $9,500 plus $200 or $10,700 before taxes. Not terrible. But imagine this keeps happening. The market has a few flat years, upside is capped, the fund keeps forcing out a high distribution. Over time, the ETF's price can grind down. $100, $95, $90, $85. You're still getting income, but your original $10,000 is slowly shrinking. It's like pulling money out of your house by selling bricks from the walls. Eventually, there's not much house left. Here's the key idea. A high dividend doesn't always mean high returns. There's a big difference between a business growing its profits and paying you a sustainable dividend, and a fund paying you a big yield while quietly reducing its own value. Some covered call ETFs can be useful tools in the right situation, but they are not magic money machines. If the yield looks too good to be true, you need to ask, is this yield coming from real growth, or is it just giving me my own money back while limiting my upside? To be fair, covered call ETFs are not always bad. They can make sense for investors who truly understand the trade-off, people who value stable income over long-term growth, those who are okay with slower capital appreciation. They tend to work better in markets that move sideways or only a little up and down, where stocks don't surge too much, option premiums help cushion small drops. But if you're young, still building wealth, and want your money to grow over decades, constantly capping your upside might not be the best move. So what can you do? Look beyond the yield. Don't just look at the big percentage. Check how the ETF price has moved over 3, 5, or 10 years. Read the distributions. Are they mostly dividends and option income, or is there a big chunk labeled return of capital? Compare with a simple index fund. Ask yourself, if I had just bought a low-cost index fund instead, would my total return be better? Know your goal. If your goal is long-term growth, you might not need super high yield right now. If your goal is income, understand what you're giving up to get it. Nothing in this video is personal financial advice. It's for education only. Everyone's situation is different, so before you change your portfolio, talk with a qualified financial professional who understands your personal situation. If this video helped you understand covered call ETFs a bit better, do me a favor. Hit the like button so more people don't turn their portfolio into a portfolio. Subscribe to the channel for more simple, no-jargon explanations on stock market investing. And drop a comment below. Have you ever invested in a covered call ETF? How did it work out for you? Your questions and experiences might help someone else avoid a costly mistake. At the end of the day, investing is not about chasing the highest number on the screen. It's about building real, lasting wealth. Covered call ETFs can look super attractive with their big yields, but remember, they cap your upside, they can slowly erode your capital if the payout is too high, and they are not a free lunch. So before you jump in, take a step back, do your research, and make sure the strategy fits your goals, not just your desire for quick income. Thanks for watching, take care of your money, and I'll see you in the next one.